you need to take to either replace, bring on board the new machine, or you retain the old machine. And we have information here that is helping you to make that decision, to make you come up with a decision on whether or not to replace the machine. So we brought this information here where we have the machine cost, that is the cost of purchasing the new machine. And the cost of purchasing the new machine there is 13,950,000, as we've seen there. Installation cost was 450,000 as given in the question there. Then I remember the way we agreed and discussed last time that you capitalize any installation cost because it is part of bringing the machine into use to make the machine ready for use. We capitalize the installation cost of the machine to be part of the total cost of the machine at the start, right? And we call it initial investment. So the total initial investment is actually the machine cost, the cost of purchasing the machine itself, then the cost of bringing the machine into the setup so that it is ready for use. That is the installation cost. So we have a total investment of 14,400,000. Then we brought now, because now we want to put up this information together and look at now, as we bring this new machine into place, we've been given information here that the machine will be overhauled at the end of year 4. Then we've also been given the economic useful life of the machine as 6 years. Then we are also being told that there is a cost of running this machine per year. And the cost of running this machine per year is 2.1 million. So that is an additional cost should the company decide to bring on board this new machine, to purchase this machine. They will incur this cost of 2.1 million shillings per year. Now, if we want to look at our projected cash flows, remember you are doing a project appraisal. And when doing project appraisal, we normally work with projected figures, right? So this is at the start. And you are projecting that this machine that we intend to bring on board, this machine will live for 6 years. Its economic useful life is 6 years. But then we are coming up with data. We are coming up with forecast information. And we can be able to tell that for us to be able to run this new machine we intend to bring, we will incur a cost of 2.1 million per year for the next 6 years, because the useful life is 6 years. And then we will also need, before we even reach the 6 years, we will need to overhaul this new machine at the end of year 4 to keep up its productivity level. And which productivity level are we talking about? The productivity level of this additional 120,000 units. For us to realize this productivity level of 120,000 units per annum, that increase in productivity level, we have to make sure the machine is at its best working condition. For us to ensure that happens, we will have to overhaul this machine at the end of year 4. And that overhaul itself will also cost us some money. We will spend 1,125,000 shillings to bring this machine back to its very right position to keep up with the production level that we expect. You get that picture? Then, at the end of the useful life, that is at the end of 6 years, we will still be able to sell this machine, dispose it off, and get a return of 900,000 shillings. So these are projections. You want to evaluate a project for a future time. You have data that you're working with, and you're trying to look at the data you have so that you ask yourself, is it a viable investment today? So that after the end of the 6 years, I'll be able to get this kind of return. If I'm likely to lose, then I should not purchase this machine. But if I'm likely to get value, if I'm likely to get good returns out of it, then I should invest in this machine today. That is the decision we are looking at. And like I've just mentioned to you guys, let us look at these things in practical sense. At the decision-making table, you will find yourself in such setups. You will find yourself in a managerial position, for example, in a manufacturing plant, in a company where you are adding value using machines. And you ask yourself, should I dispose of this machine so that I bring a new one on board? And what effect will it have on my cash flows? At the end of the day, will I get the returns that I'm looking at? You could be working in a transport sector, transport company, right? You have a fleet of vehicles, and you should already look at the policy and you say, we normally dispose of these vehicles when, for example, we've used them for 10 years, or maybe for this number of years, 5 years or something like that. You have to do an evaluation and ask yourself, when you sit at the decision-making table, you look at one of your properties, one of your properties, in that case, a vehicle, and you ask yourself, should we dispose of this vehicle and bring a new one? And what is the cost that will be involved? Yeah? You ask yourself, are we going to get value when we dispose of this one and buy a new one today? And dispose of this one? What values, what are the cash flows? What picture are we looking at? What projections are we looking at? That is decision making, project evaluation, project appraisal. That's where we are today here. Now, this rise in production capacity by 120,000 units will make the company realize a contribution margin of 45 shillings per unit. The number of units is 120,000 and the contribution margin will be 45 shillings per unit. So that is the information that we've been putting together here. So we brought the years, that is the useful life of the asset of the machine, for that is 6 years. And remember, you are doing investment at year zero. That is where you are putting your money to start this investment. And we've already seen that the initial investment amount is 14,400,000. You know why it is brought in as a negative here? Because we are following up on the cash flows. Remember, cash flows is a very important statement. Cash flows are and I remember last time when I mentioned to you guys, for those of you who are working as accountants at the moment, and for those of you who are bosses, who are employers, and your accountant in your company presents to you financial statements at the end of the month or at the end of the year, you need to know what to look at. How do you interpret those financial statements? It is not about preparation. It is about understanding and using those reports to make decisions. How do you do that? And cash flow statement forms a very core basis in which you make decisions to run whatever setup and farm you are doing. As an accountant, cash flow statement should give you a very clear picture. And when presenting your reports, those people you are presenting your reports to might not have this knowledge. Make them understand your reports in a very simplified way for decision making. You are gearing towards decision making. It's not about just presenting. They will not mark and give you marks for doing your reports. No, it is about them understanding how do they consume and make it relevant to running that establishment that you are in. Now, here we are looking at cash flows, and that's why we are bringing this initial investment as an outflow at year what? Year zero. Then now we want to follow up on the cash flows. You see, the model information we are putting in here together is to look at the cash flows. That is our interest. We are looking at all that we will get, that is the inflows, and then all that we will spend in terms of costs we will incur. Those are outflows. Then we look at the net effect. What will be the net cash flows at the end of the day? From the net cash flows, you can be able, because these are projected figures for the future, we will discount this expected net cash flows or projected net cash flows so that we get the value today. What is the value today? We are doing appraisal. Now let us get there. We started by computing contribution margin. I hope you remember how we did contribution margin. We have been given by the examiner that the contribution margin, this new machine will improve production capacity, and it will make the company realize an increase in production capacity by 120,000 units per annum more. This is an increase. And then that increase will ensure the company realizes an increase also of contribution margin of 45 shillings per unit. So when we come here and start by looking at the cash flow itself, the value increase in terms of money, We multiply the number of units that we are going to get, an increase in the units, that is the improvement in the production capacity, by the contribution margin for each of those units that we are going to realize it's, an improvement in. So that's how we got the contribution margin, by multiplying the number of units, the number of increased units per year because of the new machine, by the amount of contribution margin per unit. That's how we got 5.4 million. And that 5.4 million contribution margin remains constant from year number 1 to year number 6. Why is it constant? Because we've not been given any changes in expected contribution. This production capacity increase by 120,000 per annum, we've not been told if there will be any variations in the future for the life of the project, for the life of the machine, the 6 years. Because they expect to do an overhaul at the end of year 4, they expect that that machine will maintain the production capacity increase of 120,000. It will be maintained across for the whole of the 6 years. So that's why we also maintain the contribution margin to be the same 5.4 million for the 6 years. I hope we get that. Then, after we look at what we are likely to get in terms of money, the value this new machine will bring to us in terms of inflows, then now we ask ourselves, what costs are we going to incur? What costs are we likely to incur for the period, so that we narrow down and look at our returns? One of the costs that we identified was a fixed cost. We were given that information by the examiner. And we were told that the company estimates that it will have to spend 2.1 million shillings per year to keep the machine running. Now, it is that cost we called it fixed. Why do we call it fixed? Because we were told it is a cost of running the machine. And the machine will run for 6 years, guys. It will run for 6 years. And we've been told that 2.1 million applies per year. It applies per year. It's a constant amount. We've not been told if it will vary at some point. That's why we classify this as a fixed cost. We know the classification of costs. Yeah? We have variable costs, semi-variable costs, and then fixed costs. If we do not digress and go deeper into those costing parts, I believe at this level, you've already learned all that. Now, we brought in now the fixed cost for the 6 years, and being a cost, it is expected to be an outflow. It is expected to affect our inflows, to affect our money. So that's why we also brought them in as negatives, 2.1 million for the 6 years. After that, that is what gives us the first element of profit. And that first element of profit, we just call it earnings before interest, before tax, and before depreciation. Now, that profit element is the first category of profit that we are realizing. But now, it does not stop there. There are also some other costs that we incur, that we will likely to incur. And one of it is, we are aware that a machine will have to reduce in value over time. The value of the machine will not remain constant. Depreciation element will always follow up this machine. This machine falls under PPE, fixed assets. They will depreciate. We cannot ignore that. And the examiner went ahead and guided us on how the machine will lose value. And that information was given in addition information number 1. We were told what? The company applies straight line method of depreciation. That is the policy of the company. So if it is straight line, it makes our life so simple, because we already know the useful life of the asset. And I remember there is this formula here which we agreed on, and I wrote it there, that for us to get the amount of depreciation per year, per annum, the amount of value the value that this machine will be losing every year, we just get the cost of that machine. Then, because there is a value we will realize when we dispose of this machine at the end of the useful life, this machine, we will not just throw it away. No, we will still sell it and get something in return. And what are we going to get? We are going to realize 900,000. That value, we cannot overlook it. It is part of the value of this machine. It will not be valueless at the end. So when computing depreciation, because depreciation is the reduction in value of that asset, then we also have to deduct it from cost, so that we get the value that is net of what we will realize at the end. Then we divide by the total useful life of the machine, which is 6 years. That gives us depreciation per annum. That is how we got this 2250,000. I hope we are together there. So for the sake of autofilling for year 1 to year 6, I just referred to the initial cost of the machine, which I locked because it remains constant. That cost remains constant. That is the reference point. Then I deducted there the salvage value or the scrap value, the value at the end. Then we divided by the useful life, which is 6 years. That gave us 2250 depreciation per annum to the end. After deducting that depreciation, we reached a point where I posed to you a question. If I remember very well, I asked you, now, at the end of year number 4, at the end of the year number 4, let me just highlight it. At the end of year number 4, there is an overhaul that will happen. And I asked you, what is an overhaul? Did you guys do research on what an overhaul is? What is an overhaul? Because I asked you, if we can know the definition of an overhaul, what effect will it have on the value of the machine? And I remember I brought an example of your vehicle. If you want to sell your vehicle today, you want to make a decision whether to sell it as it is today or you want to take it for an overhaul. You want to do some work on it first before you sell it. What effect will it have on its value? And if it has effect on its value, will it affect depreciation? Will it attract some depreciation on it? That is the question I posed to you. Somebody who tried to look at it. What did you find? What did you find? What did you find?
I found out that overhaul cost it's like a repair cost.
Yes.
So if you incur that cost, it means like the value of the asset will increase.
Yes.
Because if it's a vehicle, if you do repairs on it, you'll be able to sell it at a higher price compared to if you'd have sold it without doing the overhaul first.
Good. Good. Thank you so much, Lucy, for that good contribution there. Does someone have a different view or a different finding on the same? Share with us. Share with us. We are sharing knowledge. Share with us. I don't want to lock you out. Did someone get something to also add on top of that? It might be the same, but there is something you also want to add on top of it. Or you might have a different opinion from your findings. Go ahead and share with us. Share with us.
Mwalimu,
Yes.
I'm just going to read something that somebody shared on the WhatsApp group that I found it interesting.
Okay.
It looks at overhaul from two different angles, one
Yeah.
as an expense and the other one as a capitalized.
Mhm.
Then as an capitalized overhaul cost, if an overhaul significantly extends the useful life of an asset, the cost can be capitalized. That is being added to the asset's value on the balance sheet. The new
Yes.
total cost is then depreciated over the remaining useful life of the asset. That is as
Good.
capitalized overhaul costs. Then, as
Okay.
an expense, if the overhaul is considered routine maintenance or repair, the cost is treated as an expense and deducted from profits in the period it occurs. In this case, it does not affect depreciation.
Good. Thank you, Betty. Thank you so much, Betty. I hope members have picked two important things which I've written here from that very elaborate, script that has been read by Betty. Thank you for that. Now, guys, I want to ask you, if you look at that explanation, I've picked two things from it. It said it is looking at overhaul cost in two perspectives. It can either be treated as an expense or if that overhaul cost plays a significant role in extending the useful life and productivity of that machine, then it will attract depreciation. It will be capitalized. The word is you will capitalize it if it will significantly extend or affect the useful life of a machine. But if that overhaul cost, it is just a routine maintenance, cost that comes with running the machine, then it might not be you will not capitalize it on the asset. It is just a routine cost that you will be incurring. It does not affect or extend or make sure that it maintains, for example, some level of productivity. It does not significantly extend. The word is significantly. Then you will not capitalize it. If you don't capitalize it, then now you'll just treat it as an expense. Now, in this our case, does this overall cost significantly extend the useful life of the asset? And does it affect, when you talk about significantly, does it have weight? Does it, have, an important aspect to maintain the productivity and to play a role in extending the life of the asset? Is that the case we have here?
No, we are not told if it will extend the useful life.
Yes, we are not told, Lucy, but you should be able to just tell if you look at the information given here.
I think it will increase production capacity. That means then the machine will be back in a good condition to extend its useful life.
Thank you.
Also,
Yes,
the
Rose?
questions, sorry. Also, the question indicates that the machine will have an economic life of 6 years, but will require an overhaul at the end of the 4th year. That means that for it to continue until the end of the 6th year, then it is important to have this overhaul.
Thank you so much, Rose. That word is very important. Will require. Will require. That means what? It is an important aspect to ensure that the machine runs to the end of the 6 years. Meaning what? Meaning what? It will significantly play a role to ensure that the useful life of the machine, the expected useful life, is achieved. It will require, meaning what? If you do not bring the aspect of overhaul of this machine at the end of the 4 years, it might not run to capacity to the end of the expected useful life. So that makes our scenario here, the machine that we have, the overhaul cost that we are dealing with here, it significantly extends or it significantly, improves the value of that machine. So in that case, we will have to capitalize this overhaul cost on that machine. And when we capitalize it, element of depreciation has to come in. That overhaul cost that we incur, it will attract an overhaul depreciation, and we have to take care of it. I hope we've all understood why we are capitalizing that overhaul cost. Are we together? I just want to confirm, members, are we all comfortable with that explanation? Have we all understood why we need to capitalize it?
Mwalimu, how do you know that how do you measure significantly affect if it extends the useful life? And here it's only 6 years, but we are from year 4 to year 6. Is that significant?
Lucy, give me your interpretation of this word. The machine will have an economic life of 6 years, but I want you to give me your interpretation. But what is your interpretation of that section? But the machine will have an economic life of 6 years, but what is your interpretation of that twist of words there? What is your interpretation? But the machine will have a useful life of 6 years. That's okay. But, whenever there is a conversation and you bring an element of but, that also already changes the perspective. What is your interpretation of that part?
I get it. It means there is a contrast.
Correct. So this overhaul cost will affect because the life of the machine depends on this overhaul. Are you getting that interpretation?
Yeah, I get it now.
Yes.
I
The
get
6 years.
because
Yes.
I get it because you said if it's a routine overhaul, that's when you just expense it.
Correct.
So if it affects the useful life, even if it's for a few months, you have to capitalize, right?
Yes, so the language of the examiner will guide you so that you'll be able to make a decision whether it is routine. Because in most cases, if it is a routine maintenance cost, that means you need to treat it as an expense. The examiner will in most cases use the word maintenance. they will use the word maintenance cost. You get? So,
Yes, I get it. So
yes,
if it's a routine maintenance, we just deduct it in year 4. It's an expense.
that will just be an expense. It will just be an expense. You won't capitalize it. Lewis is raising
Okay.
up his hand. Lewis.
So I guess this begs the question, does it mean that probably if this overhaul is not done at the end of the 4th year, that there is a possibility that this machine will not outlive its useful life of 6 years?
That is correct. That is correct.
Okay, thank you.
All right. Yeah, because if you look at the interpretation of the word, the machine will have an economic life of 6 years, but it will require an overhaul at the end of the 4th year. Meaning what? Without this overhaul at the end of the 4th year, this useful life of 6 years might not be achieved. So for it to achieve the useful life, it will require that overhaul. That is why the examiner brought the word but will require. Yes. So with that already now, we've all understood what the examiner meant by that. So we've all agreed that it is going to significantly extend or bring an impact in ensuring the machine achieves its total useful life. So it is not a maintenance cost, so it is not an expense, but we capitalize it. When we capitalize, there is an aspect of depreciation that we have to bring on board. And before, remember, we already have our first profit element. We call it what? Earnings before interest, before we charge tax, and before we charge depreciation. Now, we've already charged the overall depreciation. We now dive deeper and bring again this other element of depreciation when we capitalize this overall cost. Because when we capitalize it, it will affect the cost of the machine, the value of the machine. And before we charge tax, remember, I asked you last time, do we have an element of interest? Do we have finance cost in this our question? The examiner did not tell us the source of 13,950,000. Were we told the source? We were not told. We were just told that the machine will cost 13,950 and the firm will incur that cost to install it. The examiner did not tell us if this company, Fila Limited, secured any financing for this machine they intend to bring on board. How they intend to finance it, we were not told. So because we are not told, it means the company has that money with them. They have the 13,950,000. So the element of finance cost will not come into play. There is no cost of financing. They already have the money. They don't need to secure any financing for it. So that's why if we look at the first element of our profit here, now we know that the element of interest will not come in. That interest part will not come in. But should you get a question where there is an element of financing of that asset or that machine, then you have to also charge it appropriately before you charge your taxes. Now, because we don't have an element of finance cost or interest, now we need to charge tax. But before we charge tax, we normally know that depreciation is an allowable expense. So being an allowable expense, we have to deduct it before we charge our taxes. So we've already deducted the first element of depreciation. We go to the next element of depreciation, which is now coming with the overall cost, which we've agreed is going to be capitalized. So what we say there is overall depreciation. We now charge overall depreciation, the depreciation that is coming with the capitalization part of the overall cost. Now, how do we compute overall depreciation? Very simple. We were told the policy of the company. Their depreciation they charge on a straight line basis. Look at note 1. Their depreciation is charged on a straight line basis. So that means what? We just look at the capitalization, the amount by which the overall cost will be incurred, because already we are capitalizing it. So we just look at the overall cost itself. What is the overall cost? We were given overall cost here of how much? The overall cost is 1,125,000, right? So we will come here and compute its depreciation. This is how we compute the straight line method of depreciation. So when we compute the depreciation for the overhaul, we will come here and say the overall cost is 1 million. 125,000. 125,000. And we divide by the total useful life. Now, remember, the overhaul is done at the end of year 4. How many more years are remaining for the machine, the expected useful life of the machine? Because this overhaul should ensure that the useful life is achieved. How many more years are remaining at the end of 4 years? I believe you can all see it is 2 years,
I
right?
think it's,
Sorry?
do we charge depreciation in the year of overhaul?
The year,
No.
the overhaul is done at the end of year 4. At the end of year 4. So the overhaul effect on the cost of the machine is taken care of after year 4. Are we together there, Aman?
I'm a bit confused there because the cost was incurred in year 4.
I want you to understand the language of the examiner. The machine will have an economic life of 6 years, but will require an overall cost at the end. I want you to read that word and understand. When was the overhaul cost incurred? When was it incurred? At the end, at the end, at the end. At the end of the 4th year, at the end of the 4th year. So we've agreed that we are capitalizing the overall cost. Now, as we capitalize, we know that now it affects the cost of the machine moving forward. Now, when will this cost of the machine change? Will it change in that year 4 or after year 4?
Mwalimu, in when we are doing the published accounts in the asset sheet, I mean a non-current asset schedule, the fixed asset schedule. We normally, when there's changes in when there's changes during the year, for instance, the overall cost is incurred at that first, assuming that the financial year ends at that 1st December. So when we incur that overall cost on that 1st December in that particular year, do we add it? Do we realize it immediately, or we just consider the following year?
Have you met overhaul cost when doing published accounts?
No.
You are saying that that's how you normally treat it. Have you gotten a
No.
case where?
For instance,
Yes, go ahead.
For instance, we have it like there's an overhaul cost.
I'm
Do we
listening. Go ahead.
do we add it the same year, or we consider it the following year?
That's what I was asking you. And I asked you to give me your interpretation of this highlighting. You see, I highlighted it in red. The machine will have an economic life of 6 years, but will require an overhaul at the end of the 4th year. So what is your interpretation of at the end of the 4th year? That's what I was asking you.
Mwalimu, at the end of year 4, meaning you're only remaining with year 5 and year 6. Now, to get the depreciation on straight line basis, we say cost minus salvage value of remaining useful life. Then why are you dividing by 3 instead of 2 years, the remaining useful life of 2 years?
Have I done any computation of overall cost? I don't think I've done any computations.
You had started, so you had said cost minus salvage value over 3.
Hey, is there salvage value in overall cost, in overall depreciation? Did I mention that? I
Oh.
don't think so.
No.
No, I
Yes.
have not
We
mentioned
don't have
anything.
salvage value.
No, that one we've not
It
computed.
will be 0.
Sorry?
I think the salvage value can just put 0.
Yes, but we were yet to reach there. I was asking you the remaining useful life that we are supposed to use there.
Okay, it's 2 years.
Yes, so I believe we've all understood that now. So in this overall depreciation, like we've just agreed, we just take the overall cost which we've seen is now being capitalized of 1,125,000. Then in this case we don't have any element of salvage value, because remember we're just looking at overall cost at the end of year 4. meaning the expected useful life, the remaining useful life, we call it now a remaining useful life. At the end of year 4, that means year 4 is already closed. Year 4 is already closed. So we are now considering year 5 and year 6, right? So the remaining useful life at the end of year 4 is just 2 years. So to get that depreciation per annum, because we are using a straight line method, now we just divide that 1,125,000. It is 125. 1,125,000. We divide it by 2 so that we get depreciation per annum, and I'm getting here 562,500. So that is the overall depreciation. Now applying in year 5 and in year 6, it does not affect year 4 because this change takes effect at the end when year 4 is already ended. So it will affect year 5 and year 6. That's when the overall depreciation will take effect. So we bring it on board and we bring it as, in negative, so that because we are following up on the cash flows, so I will refer to the 562,500 like that, and it comes in there, the same amount there. So let me just even refer to it. Sorry. That's okay. So 562,500 like that. Now, after we've taken care of these two elements of depreciation, now we remain with an element of profit where interest we've agreed is not there. Now depreciation is off. So the next thing is now to get earnings before interest and tax. But now we know the interest element is not there. So it is just earnings before tax. Yeah. So we can just call it earnings before tax. Earnings before tax like that. EBT. So we get the net effect so that we get our earnings before tax, and the net effect takes care of from earnings before interest, tax, depreciation. Then we take care of the depreciation elements there, and we have earnings before tax for year 1. I'm getting 1050, and then because I've set the formula, I just drag to the end like that. So these are our earnings before tax. Then now we can go ahead and charge our taxes. Let me remove this highlighting. We've already understood the overall cost when it is taking effect. So I just remove that like that. So,
Mwalimu, there's some bit I want to understand.
Yes.
The aspect of capitalized.
Yes.
I've seen we've done the depreciation part, but the cost is supposed to be capitalized, am I?
I thought a member read a description and we all agreed that it is capitalized given the effect it has on the useful life of the machine. Have you just joined the session now?
Yeah, I'm sorry, I was a bit late, but
that is the problem. You know, when you join midway, you've already lost a lot and you will not be able to connect well. So that is the danger of joining in between, because you are taking everyone behind when we should.
No, it's okay. It's okay. Let's just proceed then.
So the decision came about from the interpretation of the language given by the examiner. So there is no harm in letting you understand it, because actually, you need to understand it anyway, but you try so that you make sure you start the sessions together. So if you look at the interpretation, we were told the machine will have an economic life of 6 years, but will require an overhaul at the end of the 4th year. So if you look at that language that was used here, I've not gotten the name, I've not catch the name of the member who was asking, but I want you to look at the interpretation of that language. You are told, yes, the useful life is 6 years, but it will require, meaning what? The economic life depends on this overhaul. For it to achieve the 6 years, it will require an overhaul. Meaning without the overhaul cost, without doing the overhaul itself, this economic life of 6 years might not be achieved. So in case you get an overhaul cost that significantly affects the useful life, has a significant effect on the useful life of the machine or the asset, then it qualifies for capitalization. That's a decision you'll make to capitalize. Then again, there are instances where this overhaul cost must not be capitalized. You will not capitalize it, but you'll just treat it as a maintenance cost, a routine maintenance cost. In that case, you will not capitalize. And that will come out from the language of that examiner. The examiner, in most cases, if it is a maintenance cost, they will just tell you that the machine, to run the machine, there will be a maintenance cost of this amount per year. In that case, do not capitalize. If you don't capitalize, then it means there will be no overhaul depreciation brought by it because it will not change the value. It will not have a significant effect on the value of the machine. So it is all about the language. Because now this overall cost will change significantly the useful life of the machine, because useful life of 6 years depends on it, then now we qualify it as a capitalization cost. We capitalize it because of that subjective nature of that cost on the economic useful life. Remember there, have you gotten something? Have you gotten something?
So the bit is now the initial investment cost of the 14.4.
Yes.
Capitalization means it's supposed to be increased.
Remember, we are at the end of year 4. We are not affecting the initial investment at year 4.
Okay.
So I want us to move bit by bit. We started by the initial investment. As we do the capitalization, remember, this is just an overhaul cost. The reason why the examiner is bringing that overhaul cost at that point, is because the examiner knows very well that whatever they're trying to test is, how will you classify that overall cost? Will you classify it as an expense, or will you charge some depreciation on it? You get?
Okay.
So that is what the examiner is trying to test you here. But remember, this is just an element of overhaul. The depreciation, that is just an element of depreciation. But that overhaul that we are deducting here, the overhaul that we are deducting, the overhaul on which we are computing the depreciation, we've capitalized it on the asset. And I don't want to go to the direction of asking you, what is the value of the asset from year 5? Let us just go through it this way. Then at the end of the day, we will see the whole picture, because somebody will get confused at that point.
Okay, thank you.
Yes,
thank you.
yes.
Thank
So
you.
let us just proceed. Then you'll be able to see the picture very clearly. Let us not look at what is now the value of the asset at the end of year 5. What is the value of the asset then at the end of year 6, and what effect does it have? Let us just look at it in terms of cash flows first. Then at the end of the day, we are going to look at the whole picture. Good. So
it's understood.
good,
Understood.
good.
I think that's the direction I was taking, but it's okay.
Okay. Thank you, Ernest. Thank you for that. Good. So let us come. We already have our earnings before tax. Now we can go ahead and charge tax. What did the examiner tell us about tax? Let's go to the question. Additional information number 2. We were told corporate tax rate is 30%. So that is so easy. We're just charging 30% of that earnings before tax. So I come here and say tax. So let's just go ahead and charge our tax, and the tax is 30%. So just 30% of the earnings before tax, like that. Then that tax rate, it applies to the end, but then I want you to be very careful. And look at the changes in earnings before tax at year 5. You will realize that all these earnings before tax from year 1 to year number 4, they are the same. And the reason why now the earnings before tax at year 5 is different is because of the overall depreciation. So that is now the effect it has on our cash flows. We are taking care of that depreciation. So our cash flows are big different at this point. Remember, our cash flows were all the same from the start. Even at the point we charge depreciation, the overall one, now our cash flows are changing. And therefore, even the tax that we are going to pay will have to change, because depreciation is an allowable expense. So it is reducing the burden to us, to this company. Because it is allowable, so it is reducing the burden. So you see, you can see in year 5 and year 6, we are actually paying less. We are actually paying less tax. There you go. Now, after charging tax, what do we get? We get profit after tax. Which is, I ought to have brought this tax with a negative. so that we directly just take care of it. Let me just do that. Okay. So to get profit after tax, we just get the net effect. We deduct our taxes there. Then we have our profit after tax to year number 6, like that. Now, these are our figures of profit after tax. We go ahead because we deducted depreciation before we charge tax because it is allowable, right? It is allowable. But I want to believe all of us here at this level, we've done published accounts and we understand that taxes, depreciation that is being charged in the income statement, it does not mean it is paid. It is just recognized, depreciation being recognized on accrual basis. And because we are following up on cash flows, we are following up on movement of cash coming in and cash going out. I know someone already has a question on tax. Yeah? Someone already has a question on tax. For the tax part, the tax that we pay on the incomes that we get, that tax, we might not really pay the full tax in that particular year. For example, in year 1, if you're looking at the tax being paid, you might not really pay the 315,000. It's okay. But at the end of the day, we know there is an element of deferred tax. There is current tax and there is deferred tax. And we know deferred tax is a long-term liability. I believe we know that long-term liability, and current tax is a short-term or a current liability, short-term liability or a current liability. That is something we know. Now, putting this one in mind, you know that at the end of the day, these taxes will have to be paid. Whether you defer it, you don't pay in full because of the approach of the taxman, maybe the computation by the taxman. You people are doing tax at the moment, and I believe this is something you understand. And we've also done published accounts. So let me see, someone is saying something. Vincent, earnings before tax. Why are you getting different values for earnings before tax? I'm wondering. Well, let me look at the earnings before tax. Vincent, have you brought in the overhaul depreciation for year 5 and year 6? Do you have the same figures? Vincent, talk to us, Vincent. Do you have the same? Have you brought in the overhaul depreciation for year 5 and 6, Vincent? Have you done that? Now, Vincent, you can unmute and just talk. You don't have to type because it takes a lot of time. So if you have the overhaul depreciations, how come your earnings before tax figures are different? Do we have this earnings before interest tax depreciation, the same figures? I'm wondering why your figures should be different. Where do you have a different figure, Vincent? Talk to us. Vincent, talk to us. Why do you have different figures? Which figure is different for which year? Which year? Vincent doesn't like talking. Vincent, just unmute from your end and speak. Vincent is not talking to us. Vincent is not talking to us. Vincent is not talking to us. So we continue. So now.
It could be the salvage value. Maybe he didn't subtract the salvage value in the depreciation.
Yeah, so Vincent, check on your overall depreciation. Check on it to make sure you take care of it in year 5 and 6.
I said he found it.
Oh, okay, it's okay. Okay, I didn't see the chat. Okay, good. Vincent has already gotten it. Good. So we have our profit after tax. And I was bringing an element of the view of whatever expenses we normally charge in the income statement. And when we are looking at the cash flows, what do we look at? We all know, how do we normally prepare statement of cash flows? We normally start with profit before tax, and then we do adjustments. Yeah, we normally adjust non-cash items, non-cash. And we know very well that depreciation is one of the non-cash items. I believe we know that. Because it is normally charged as an expense on accrual basis. Yeah, so it does not involve actual flow of money until it is paid. But again, is there anyone who has ever gone to the bank to pay for depreciation? Who are you paying depreciation for? depreciation is an uncash item. We all know that. So that's why when following up on cash, we have to recognize our depreciation. We do not deduct our depreciation. It does not have effect on our cash flows. We were just deducting the depreciation so that we compute tax. But after computation of tax, we bring it back. It is not an expense. We are not spending money on depreciation. So we come back and say, add back depreciation, add back depreciation. And we have two elements of depreciation. I believe you remember that. So I can even just go ahead and refer. Which was the first depreciation? The first depreciation was this one. Now, because it is in negative, I want to bring it here as a positive. And because I've referred to it, I just autofill to the end. The 2250, you see where I've gotten it from. That is the first element. The second element of depreciation we deducted before computing tax was this overhaul depreciation. So we also add it back. We have not spent money on this overall depreciation. We just recognize it in our income statement for purposes of computing tax so that we don't charge tax on depreciation being an allowable expense. But then we add it back. It does not affect our cash flows. So we make sure we bring it back. Add back. Add back. Overhaul depreciation like that. Overhaul depreciation. So I hope this direction we are taking now, you understand why the examiner brought this aspect of overhaul. The examiner just wanted to catch you here. Do you understand the effect of overhaul on depreciation and to tax? That is what the examiner was testing here. Nothing much. That is only what the examiner was testing. The examiner was not interested in asking you, tell me the value now of this asset, of this machine at the end of year 5. What is the value of the machine at the end of year 5? That is not what the examiner was testing. The examiner just wanted to prove that you understand the connection between the categorization of this overall cost, whether it is maintenance or it should be capitalized. If it is capitalized, what effect does it have on depreciation? Then what effect, how do you charge tax? What effect does it have on tax? Then finally, what is the overall effect on your cash flows? And now that's why we are coming here and adding back our two elements of depreciations. And the overall depreciation is only in year 5 and in year 6. So we come here in year 5 and I refer to the year 5 one like that. Then I also bring in the year 6. We are adding back. So when we add back, we are going to get now our total operating cash flows. And I will call it there operating cash flows like that. So what is our operating cash flows? Our operating cash flows start from profit after tax. Profit after charging tax, then we add back our two elements of depreciation like that. And I'm having my operating cash flow 2985 for year 1. Then I drag it to year number 6 like that. Those are the operating cash flows. Let me just highlight. Then now from there is where we are. We want to look at now the overall perspective of our cash flows. We come there and ask ourselves, now, we've already taken care of this tax. We've already taken care of depreciation. We are looking at our cash flows. What else is going to affect our cash flows? Are we going to spend, or there is any money that will come in before we close the useful life of the machine? Let us go back to the question and look at it. Now, the overall cost, we've already taken care of it. Now we come to this other part. After 6 years, after 6 years, the machine will be disposed at what? At 900,000 shillings. Yeah? After 6 years. Look at that language of the examiner. It is after 6 years. So it is after the end of the 6 years that the machine will be disposed and it will realize 900,000 as the salvage value. Of course, 2.1 million was the fixed cost, the cost of running the machine. We already took care of it. Then an addition annual operating costs, okay. Any other element we are forgetting to take care of? Increase in capacity, we've already taken care of it. So I'm not seeing anything much remaining. The only thing we've not taken care of is what we are going to get. Remember, disposing of the machine at the end of year 6, at the end of its useful life, is selling it off. It's just about selling it off. And when you sell it off at that time, the amount that we're going to realize is 900,000. So that is money that will come in. We expect the money to come in. Remember, these are future figures. we expect to receive back the salvage value. The money we will get when we sell the machine at the end of its useful life is 900,000. So being money that we will receive, it is an inflow. So we have to recognize that inflow in our tracking of our cash flows. Yeah. So it is money coming in. So we say there salvage value. Salvage value. Sometimes you can call it salvage. Sometimes you can call it scrap value. Value at the end. So where does it come in? We realize it at the end of year number 6. So it is money we will receive when closing year number 6. And how much is it? We've seen it is 900,000. 900,000. So it is an inflow. It will affect our cash flows. It is money coming in. So that will give us what we call net cash flows. Net cash flows, like that. Net cash flows. So you see, our interest is just to follow on the cash flows. That is our interest. As an investor, you are looking at what are you going to get? What are the returns in terms of money? That is what we are looking at. What value are you going to get? So to get our net cash flows here, we just get the net effect of operating cash flows and we adjust it with the any other cash flow that we are going to realize. And this only happens in year number 6. That's where the 900,000 is going to come in. So these are the net cash flows that we have, that we are likely to get or maybe to realize in the entire useful life of this new machine that we intend. Remember, we are just doing an evaluation whether to buy this machine or not. So these cash flows, these are projected figures. These are cash flows we expect, given the scenarios after considerations and these figures that we have. This is what we expect to receive for each year to year number 6. Now, we ask ourselves, how do we now make a decision from this point? We've already seen our net cash flows, year 1 up to year 6. We've recognized everything, all the expenses we are likely to incur, and everything that we're likely to get in terms of inflow and outflow of money, of cash. So we move to the next level and we ask ourselves, how do we make this decision now? Whether or not to invest in this machine, whether or not to invest in this machine. So we go to the additional information and get something the examiner told us. The examiner told us in note 3 that Fila Limited requires 20% return on all investment. So that is the rate of return. In other words, that is the cost of capital. That is the COC. That is the COC, the cost of capital. We've been told it is 20%. We bring it there. Then we know, even the examiner even told us the project evaluation technique that we employ here. You are told using the net present value project evaluation method. So the examiner even told you what to use. So there is nothing difficult here. We all know how to compute NPV. So that is what we are going to compute. What is the net present value? Using the NPV formula, equal sign, NPV. I pick the formula like that. Then what is it asking me? To input the rate. Where is the rate? This cost of capital here. So I just pick the rate, the 20% like that. Then I put a comma. Then it is asking me value 1, value 2, value 3 as it moves. So what am I picking? I am picking the net cash flows. The net cash flows. From where? I'm picking the net cash flows from year number 1. And even before I proceed further, let me just remove this. You remember we have year 0, right? We have year 0 here, of which I need to bring its cash flow, the cash flow in year 0. Let me also bring it there. Yes, there we have it. So in our net cash flow figures, remember, in year 0 is when you are making the investment. This is the amount you are spending in year 0. And when you spend this amount in year 0, these are the cash, the cash flows. These are the monies that you expect to receive from year 1 to year number 6. This is the cash flows that you expect. Remember, you are at year 0. This is now. You are spending today. But these figures that you have here, they are future values. These are future figures, right? So because they are future figures, we want to ask ourselves, what is the value of these future figures today? What is their values today? That's where we talk about discounting. We are bringing future values to get their value at present. We get the present value. You get the present value. And like I told you before, when discounting, We know that when you want to look for future values, you are compounding. But when you want to get present values, you are discounting. So that's why we call this formula net present value. Net present. We are getting the value today. So if you want to avoid using the NPV formula, you can go and get the discount factors. We know how to get the discount factors, right? The PVIF, the present value interest factors, 1 plus R raised to negative N. We all know that, I believe so. So if you want to do the discount factors, you can as well do discount factors for year 1, year 2, year 3. Then now you multiply the net cash flow by the discounting factor. Net cash flow, discounting factor. Net cash flow, discounting factor. Then you add all those net present values, the present values, so that you get the total present value. It will be the same as what you get when you use the NPV formula. At this level, we don't expect you to go to the level of typing each and every, these discounting factors per year. It will consume a lot of your time and you'll waste time for no reason. That's why the NPV formula is here to make your work easy. So we come here and say NPV, like we started. We pick the rate 20%. Then when picking the values, do not start picking the values from year 0. No, we are starting from year 1. That's why even the formula is saying value 1. So interpret it as value in year 1. That's how you should interpret it. Value in year 1. So you start highlighting the net cash flows from year 1 to the end to year number 6, like that. You close that bracket. Then you compare with the initial investment that was put in. Remember, our initial investment, we brought it in as a negative. You see it is in brackets, meaning what? It was an outflow from the start. All these others are in positive. Why? It is because these are the cash flows that we expect to receive. It is their inflows. That's why they are all in positive. The first one is in negative because it is an outflow. These ones are inflows. That's why they're in positive. So in NPV, we know the NPV formula. It is the total present value of cash inflows. Then we compare or we deduct the amount we spend from the start. We call it initial investment or present value of cash outflows. So we normally deduct whatever we spend, the initial investment. But because it's already in negative, we just add the initial investment of 14,400,000. This addition should not confuse you. I'm adding because it's already negative. If it was in positive, I would not add, I will say deduct. But in essence, this addition will turn into negative. We are comparing, we are deducting. And I'm getting my NPV there. And you see the NPV is coming as a negative 4,047,613. Now, this is the NPV. Now, make the decision. Make the decision. What decision will you make for this company? What is the name of the company? I'm just confirming the company is called Fila Limited.
The
So
project
what will
is
you tell
not
Fila
viable.
Limited? Yes?
The
It's not
project is not
viable.
viable.
Yes, it is not a viable decision. They should not purchase. They should not purchase the new machine. They should not purchase the new machine. Yes. So you will tell them not to. Do not purchase. Do not purchase the new machine. So this one tells you it is not viable because the net present value is negative. Yeah, so that is the decision that you are required to make at that point. Then there are those additional sections. They are not additional. There are those additional sections that we also need to look at. They were tied to that, even though we know that this was the final part for the examiner. That was the final part for the examiner. Using the NPV advice, we've already advised. But what if someone asks you to now compute the payback period, and then discounted payback period, and then profitability index, and then use a chart to calculate the IRR? These are things you've done. You've done ratios. You've done these ones before. This one should be very easy. How do you compute the payback period? And what is the difference between payback period and discounted payback period? Discounted payback period. Are we getting the difference? Then IRR. Yeah, IRR. Use a chart to compute or to calculate the IRR. In fact, This payback period, discounted payback period, and profitability index, these ones, I think they should be very direct. What is the formula of profitability index? PI. How do you normally get PI? Let's remind ourselves. PI.
Present value of cash inflows over present value of cash outflows.
Present value of cash inflows divided by present value of cash
outflows.
That is very direct and very simple like that. That is how you normally get. And let me ask you something. Profitability index. What is the difference between profitability index and internal rate of return? How do you get internal rate of return? This is a very interesting one. I want you to differentiate that. Now, how do you get IRR? Somebody. If profitability index is present value of cash inflows or present value of cash outflows, how do you get IRR?
I think IRR is where the
avoid using assume. I know here is telling us to use a chart. You are going to use a chart, but in case you want to compute it, how do you compute it without going to the chart direction first?
NPV is 0. Equal the NPV to 0.
IRR, internal rate of return. We forgot. We forgotten.
IRR, it's where the
Na kila kifomula kimoto kia kusema ineshi unandivide nini huwezi kumbuka.
You guys, do you know exam is around the corner? Wow. This and CFO J is saying this is trial and error. CFO, you don't even believe the formula you're giving us. You're giving us a formula and tell us it's trial and error.
Profitability index times 100.
Look, guys. What is the difference between profitability index and IRR? Yes, what is the difference?
Yeah, the profitability, the IRR, you multiply by 100.
And profitability index? You guys, you can't be serious. Then, with all these technical things you've learned, now you are coming back to the easy. You know, that is the problem of learning so many complicated things. Because you end up even forgetting now the simple ones you can't do. You see? So guys, don't concentrate too much on the technical part. Look at these simple things. Because exams is not difficult, by the way. You will end up computing until you pass the answer. Until now, you start even questioning yourself. Yeah. And then you realize you're only complicating the simple thing. Let me see. IRR, you include all values. Masoti, you all want to pass. So,
You
guys,
just equate
yes,
all values, including the outflow.
that is in IRR.
Yes, you use the Excel, you type equals to IRR, then inakupatia hiyo kakitu. Sasa sijui, yes, tuliambiwanga whatever you told us, whatever is in the bracket is not a must.
Yes, whatever is
Na
given
hivyo
in
tu mtu
bracket within a
anapita.
function, yes. So it's okay. Guys, no worries. I know at the moment you realize you have a lot of things to look at, but then I want to ask you, please do not confuse yourself. Just, you see, whatever you've learned up to this point is more than enough for you to pass. I had told you this thing way back. The contents that you've covered, it is way more than enough. So do not stress yourself with, to confuse yourself further. Now, I want to take a very simple approach here. I do not want to complicate anything. I want us to concentrate on one thing here. And I want us to tackle this part first. Use a chart to calculate the IRR. But then there is an IRR functionality. And the IRR functionality, just say equal to IRR. And then it tells you values. I want you to look at how that functionality is coming. Just asking you values. And then there is a bracket saying guess. We don't want to guess anything. We just want to bring in values like that. There is nothing complicated about that. Just values. So you'll just come here and highlight values. Values from year 0 to the end. Just close and then confirm. You get that? It is just about values like that. And then we stop it at that point. So it is bringing us, this is 8%. You can even increase the number of decimal places so that you have it as in two decimal places. Let's say, for example, like that, 8.41 or something like that. Good. So let us draw a chart so that we can also compute the IRR. And in fact, there is no examiner who will ask you to use this Excel functionality to get IRR, because that is more than easy. In most cases, they will bring this one. You see this question here, they will ask you to draw a chart so that you compute IRR. That is how they will set that question. So do not expect an examiner asking you to use an appropriate Excel function to compute IRR. That will not be given. That one, just forget. You will always be asked to draw a chart to compute IRR. So that's what I want us to do. Let us draw the chart. How do we come up with a chart to compute IRR? How do you come up with a chart to compute IRR? It is very simple. I want you to concentrate on what is IRR. What is IRR? What is the definition of IRR? Internal rate of return. What is internal rate of return? No one is speaking. You forgot. This thing we've covered before.
NPV is equals to zero.
Temperature is increasing.
Where the NPV is equals to zero.
So IRR is the discount rate when the present value of cash inflows will be equal to the present value of cash outflows. In other words, NPV is equal to zero. Simple interpretation. IRR is the discount rate when the total present value of cash inflows will be equal to the total present value of cash outflows. And at that point, NPV is what? Is zero. NPV is zero. That is IRR. That discount rate, when NPV is zero, is what we call IRR. That is what we call IRR. Good. Yes, exactly, Lois. That is another good interpretation. It is when the company is not making a profit or making a loss. Yes, that is the break-even point. You can even use the word break-even point. Lois, that is a very good interpretation to understand what it means. You see, whatever you spend is equal to what you are getting. So you are not making a loss, you're not making a profit. And that is when NPV is zero. And that IRR computation, you can even compute it from here. You see here, we've computed our NPV, right? You can use goal-seek. You can use goal-seek to set this NPV to zero. You remember there is a computation we did that was, we did it in that perspective when we wanted to get the initial investment. The cash flow in year one, was it in initial investment or my cash flow in year one? Something like that. So if at this point, you use goal-seek to set this NPV to zero, whatever cost of capital and the discount rate that you will have here, when you change that cell of discount rate, whatever you get here will be your IRR. And you are most likely to get the same figure that we've gotten here, the 8.41, using that formula. So let us use a graph, use a chart, so that we come up with that IRR. How do we use a chart? So we know that it is a discount rate when net present value is zero. So the variables that we are handling is the cost of capital or the discount rate and the NPV. Those are the two variables. So let us bring those two variables into play and come up with that point of IRR, where the line graph will cross. The line graph will cross the NPV line. Where it crosses the NPV line, where NPV now is zero, that point is where IRR is. And that is what the examiner will bring to you to compute it using a graph. So let us see how to get it. The two variables we know, it is cost of capital and it is NPV. Those are the two variables making up IRR. Cost of capital and NPV. Cost of capital when NPV is zero. So those are the variables we are comparing. And I want us to compare it using the computations we've done up here. So I want to refer to the NPV figure we have here. I want to bring it on board here. I've told you can use goal-seek, but then I don't want to use goal-seek because it will interfere with our computation here. I want us to use a different sensitivity analysis tool, which is data table. We want to use the data table to get these outputs. Because we have a range of inputs and outputs, goal-seek is not really the best tool you can use here. Goal-seek only uses one input, one output, where only one variable in one cell and you need one output in one cell. But whenever you need a range, then now goal-seek is out of that coverage. Now, when you want to draw a graph, the graph has to be normal. Remember, a graph has to be a normal graph. A graph do not have just one value. A graph has a range of values. And how do you get to tell the range of values? I want you to look at the cost of capital you have. It is 20%. So we need to get values before 20% and after 20%. And it is the cost of capital when NPV is 0, right? And I've told you can use goal seek to set it here so that you get to know the cost of capital you are looking at. And we've already computed the IRR. Here it is what? 8%. We've already computed it here. It is 8.41%. So having already known this, this one is like we already have a leakage. We already know where it falls. You see that? We already know that cost of capital will fall around 8.41. It will fall around here. So having that in mind, now we can come up with a range of cost of capitals. And now we have to pick figures before 8. We have to pick figures before 8 and after 8. Before 8 and after 8 so that our graph will be a normal curve. So which figures do we pick? We can even pick from 5%. We can even pick from 5%. We go to 6%. And I want us to go all the way past the 8% so that we see a normal graph coming up. So we can even go to, for example, 16. I'm a 15. Let me just stop it at 16. It's okay. That is the range of cost of capitals we are coming up with. We are trying to identify which cost of capital, at what point will we have an NPV of 0. So after we interconnect this, we've come up with the range of cost of capitals and we've referred to the NPV. It is now very simple. We are going to use data table to come up with this. So to use a data table, just highlight these two columns like that. We go to the data tab. We go to what if analysis tab. Then we choose data table. We choose data table. Now, how many variables are changing in our case? Somebody just remind us, because these are things we are reminding ourselves. We've done them. How many variables are changing at the same time? How many variables do we have?
One variable.
Only one.
Yes, it is only one variable changing. That means we are using one tail data table or one variable data table. Now, what is the alignment? In this data table pop-up window, am I choosing row input cell or am I choosing column input cell? Let's remind ourselves.
Column.
Row input cell. Column, sorry.
Column input cell.
Column.
Correct. We are going
Column.
the column input cell. I hope we all know why it is a column input cell. We check on the alignment of the variable that is changing. And the variable that is changing is aligned in a column, the cost of capital. So we go to the column input cell. Now, tell me, in that column input cell, yeah, which cell do I click so that we get to auto-populate our NPV figures corresponding to those cost of capitals? Another
8%. Where 8% is? Where 8% is?
20%.
You click on
20%.
20% cost of capital.
Oh, 20%, sorry.
Where
Yes.
20%
For the
is.
NPV.
Yes, because it is what is changing, we go to 20%, right?
Yes.
Right?
Yes, 20%
Yes.
is recurrent.
This is interesting.
Because it is
Okay.
that 20% that we have
Yes.
used to calculate the NPV.
Good. So let
Then
me
we
go
will
and
pass.
refer to the 20%. Yeah, and then I just confirm by saying okay. When I say okay, we have the range of NPVs corresponding to that. So I just do some formatting. It is good that we all remember, because that is the most important thing. We remember what we were doing. Good. Now, there you go. We have the range of cost of capitals and we have their corresponding NPVs. Now,
Mine are becoming the same, are giving the same NPV.
sorry?
Mine are giving the same NPV.
No, it cannot be the same. You must have selected on a wrong variable. Did you click on the cell where we have 20%?
Yeah.
I want you to activate your NPV formula and where your NPV computation was done. Did you refer to the 20% or you typed the 20%?
I typed the 20%.
Now that is where the problem is. You should refer to it when computing that NPV. Because when you refer to it, you are interconnecting the cells. You are interconnecting the cells. It is a web. so that whenever you will refer to it, it will cascade and affect all the other variables depending on that cell. So make sure you don't type the 20%. You refer to it in a cell, and it is that cell now that we are using here when coming up with this data table. Yes. I hope you've gotten it. Now, after having these our variables, our figures for cost of capital and NPV, now we go ahead and draw a chart. We go ahead and draw a chart to represent that information. So the chart we are drawing is all the way from cost of capital to the NPVs. But I don't want this NPV that we referred to. You see this first row. We don't need that first row of NPV, this NPV which we refer to up here. So because we don't need it, what I normally prefer, because it helped us to compute that, I normally prefer just copying it safely and putting it aside as values. Then I comfortably remove it. Then I adjust my columns and my figures like that. Then I can now easily highlight the cost of capitals and NPVs. Then after I've done that, I go to insert. What are we inserting? We are inserting charts. So I will just go to all charts. We have recommended charts, of course. They will always be there by default. But then you can as well go to all charts and you see which type of charts do you think will clearly show what you want. So we can even start checking the recommended charts and see. Let's look at this clustered column. We know clustered column is usually best when presenting values, But remember, we are looking at cost of capitals against net present values. We want to see at what point is our NPV going to be zero, meaning our NPV should be on the x-axis. NPV should be on the x, is it x-axis or y-axis? Y-axis. NPV should be on the y-axis, and then cost of capitals should be on the x-axis. So where the line crosses, where NPV is zero, that is where our IRR should be. So that's why I will go to the next recommended. Clustered column is good for values only. I go to the next one, is called clustered bar. Anything clustered normally good for values only. It will always show it best. And then I look at the next suggestion they're giving. I'm looking at this scatter. And I'm tempted to pick this scatter because I can see a clear line. I can see some clear line there, and I can even read the description telling us a scatter chart is used to compare at least two sets of values or pairs of data. Use it to show relationships between sets of values. And for sure, we are looking at the relationship between changing cost of capitals and the effect it has on NPV. That is the relationship we are looking at. Yeah, so I can be tempted, and I think I can go ahead and pick this scatter. I don't say that you have to pick the scatter. No, pick that which you feel best represents your data. You can even check the next one is waterfall. Waterfall, I think it shows the cumulative effect of series of positive and negative values. So this one interpretation might not be very easy because it's about cumulative effect, and that might not clearly bring out what we are looking at in this case. If I go to the next suggestion they're giving, I see they're giving a line graph, and I think line graph is used to display trends over time. But again, it is used where main data points are important. So this line graph also, I think it will give us some good perspective of looking at our interpretation of what we are looking at. So you can either choose, I can go for scatter, or I can use the line graph, whichever. But because I had settled on scatter first, let me just pick the scatter for my case. But for your case, you can pick that which you feel will best represent your data. So if I pick on that, I want you to look at that. Then we can even change some information about the chart. Let me go to, do I want to switch rows and columns? No, I think the rows and columns are okay. So select data, and I'm looking at this. Let me see. X-axis, we have the cost of capitals, which is okay. And the cost of capitals, you can see they are coming as decimals. Why? Because our figures are here are decimals. But you can as well change it. You can as well change it to percentages like that. You can as well change it to percentages. And if I change it to percentages, you can even see the effect is changing on our chart, on our graph here. And I told you that IRR is the discount rate when NPV is 0. Now, y-axis is NPV. Y-axis is the NPV. And then x-axis are the discount rates. So at what point do we have an NPV of 0? The NPV of 0 is here. You see at this point. Now, what is the discount rate at that point? Remember, whenever you draw a graph or a chart, remember to name the axis. Give the axis titles. Give the access titles because it will always be checked by the examiner. Give the access titles. And I'm not saying you have to use this scatter chart. You can use the line graph. It will still represent the information. So the title you can give here, you can give a title of your choice. You can say maybe relationship between cost of capital and NPV, or cost of capital versus NPV. Whatever description is not cast on stone. You can just type whatever title you wish to do. But then my interest is to look at the point of intersection. I want you to look at this point of intersection. If I can maybe enlarge my chart a bit. You see the point at which the line crosses the x-axis. That is the point where we have our IRR. I don't know if you can see some figure there. It is estimating it to be around 9%. Yeah? But ideally, you can see it is not exactly between 8 and 10. So meaning it is less than 9. It is less than 9. And because we've already used our Excel functionality to confirm, and we all saw that our IRR should fall around 8.41. That should actually be that point. And we can even change the type of chart. We can change the type of chart so that we be able maybe to see a clear picture. We can change the type of chart. Let me see. We can go ahead and even change the type of chart. I'm seeing some charts here. People are, I don't know whether they're questions. Let me see.
Excuse me, Mwalimu.
You didn't refer.
I'm having a challenge on the insert chart pop-up menu.
Yes.
It's telling me that recommendations are not available for the data you selected.
That's okay. They don't have to recommend for you. You go to all charts. Go to all charts.
Okay. Okay.
Yes, so if they don't recommend, it's okay. It's okay. Given the version maybe of the Excel you're using, it's okay. But you should be able to go to all charts. Just go to all charts and then you choose whichever chart you feel will best represent the information that you want to present. Yeah, even if they don't recommend, worry not. You just go to insert. When we are at insert, then you just go to all charts like that. Then you will always see them. You'll always see all the recommendations. I can even go ahead. If you look at the line, for example, I can even pick that line graph like that. Yeah. So if I pick the line, you can see it is coming there. And our interest, like I told you, it is where NPV is 0, the point where it crosses the NPV line and it is 0. So if I put side by side the line graph and the scatter, let me see, it is interfering. It's not dragging very well. Okay, good. So you can see this was a scatter one, and then this one now is a line graph. So you can be able to see the line graph there, and you can be able to pinpoint and see at what point is it crossing? At what point is it crossing the NPV line where NPV is 0? And because we've already known where our IRR falls, you can be able to just insert you can just insert a text box. You come here and pick a text box and just highlight that point and say at that point IRR is equal to because we had confirmed this using the Excel formula, we got what? 8.41. Just come there and say 8.41. You're just confirming what you already know. Remember, you already know the IRR. You're just confirming. You're just confirming to them that using a chart, using a graph, the IRR still falls within the same area, 8.41, like that. So I think that is that. I will leave the part of payback period. That is very easy. The period you will take to recover your investment. What investment are you recovering? You are recovering 14.4 million. So you just look at the cash flows, look at the cumulative figures, look at what point are you going to recover this amount. I think this is something we have done. There was a question we did about that. and it is not anything difficult. And when you talk about discounted payback period, make sure you discount all these cash flows. And when you want to look at the payback period, discounted payback period, you will now go down and look at the discounting factors per year. You will not escape that now. You cannot use NPV formula because NPV formula gives you the total present value of all of them. But if you want to get the payback period, go year by year. Get the discount factor, multiply so that you get the discounted cash flow per year. Then now you accumulate them per year, then get at what point are you going to recover your initial investment. It is the same approach. The only difference is the type of cash flow you are picking. The one is discounted, the other one is not discounted. So that is the difference between discounted payback period and non-discounted payback period. So guys, I
Mwalimu, where
think
did you get the
that,
line graph?
sorry?
Where did